Hey guys, today in this video I will teach you about the stochastic oscillator. This indicator is very similar to RSI and MACD because it also shows the overbought and oversold conditions of the price. Using these types of signals, traders can anticipate price reversals or areas where they can close their profitable positions for the purpose of managing risk. However, one notable difference about the stochastic oscillator is that it should be used in range-bound markets rather than in trending environments. The RSI, for example, measures the velocity of the price change and therefore it is more useful for trending situations. The formula that is used in the stochastic, however, is calculated a little bit differently, and as I mentioned before, it is best used in the sideways markets. In general, the formula uses 14-period price data for calculation, so the indicator value can be identified by using the following method. To come up with the value, we first need to subtract the lowest closing price during the 14-period trading range from the most recent closing price. The resulting number should be divided by the difference between the highest and the lowest closing prices created within the 14-period time span and multiplied by 100. Now the good thing is you don't really have to worry about the calculation because your platform will do this for you automatically. But regardless, I wanted you to at least be aware of how the indicator value is calculated. Speaking of the values, they always stay between 0 and 100. Generally speaking, any reading that is above 80 implies an overbought condition, while a reading below 20 indicates the oversold one. This data is convenient to use during range-bound markets when the support and resistance areas are clearly visible. Similar to the MACD, the stochastic consists of two different lines that can intersect to produce buy and sell signals as well as divergences. The first line represents the actual and current value of the oscillator and is shown on the chart using the %K symbol. This is sometimes referred to as the fast stochastic indicator. The second line is its 3-day simple moving average, which smoothens things out and shows the longer term trend for the current prices. It is represented by the %D symbol. This one is often referred to as the slow stochastic because of how it is constructed using multiple days data. So let's take a look at an example of the stochastic on the daily chart of the USD/CHF or Swiss franc. As you can observe, the USD/CHF is in a sideways trend where the support and resistance areas are clearly marked. Anytime the price reached the support or got close to it, we can see that the indicator dropped below 20 and when the price hit the resistance above 80. In a range-bound trading environment, this is the simplest trading methodology that anyone can utilize to make consistent profits. It is to buy when the price reaches the support area and the indicator drops below 20. Conversely, sell when the price reaches the resistance and the indicator shows a value of above 80. Now let's discuss crossovers. When the fast stochastic crosses the slower one in the right place, this can give traders signals of possible reversals or at least reveals a change in the sentiment. As a rule, most reversals happen inside either support or resistance areas. Therefore, looking for these crossovers in these specific zones can produce good buying or selling opportunities. Let's zoom in on the same USD/CHF chart and take a closer look at the areas where the crossovers occurred and led to the reversals. First of all, I will be looking at only inside support and resistance areas because this is where the most reversals happen. Here's our support area where the price bounced strongly by posting several strong bullish candles. As you can see, the first bullish crossover did not result in a reversal. The reason is simple: the price has not reached the area where buyers are willing to buy en masse. However, the second time the fast stochastic crossed over the slow one, it produced a nice bullish reversal. This is because the price reached the support area where the majority of the buy orders were waiting to be fulfilled. This is why it's so important to not only pay attention to the crossovers, but also watch closely for the locations where they occur. In case of a bearish reversal, the same criteria also apply. The price needs to reach the resistance area or very close to it for the crossover to produce a good reversal. As you can see on the chart, we have a beautiful resistance area that was established after a strong price drop. The price reached the resistance area without creating any red candles in the process, which is a big plus. The faster the price travels to the area of interest, the faster it usually drops once reached. In our example, we can see that the second drop was even stronger than the first one. the indicator's bearish crossover created the signal to sell right before the drop occurred. Besides crossovers, the stochastic indicator also gives traders another type of signal called divergence. A positive divergence occurs when the price shows weakness but indicators such as stochastic show strength. Take a look at the daily chart of USD/CHF again. The part we're examining is this particular downtrend during which the stochastic indicator was following the price until there was a point where the divergence occurred. The indicator started rising when the price still made another lower low after a brief bounce. But this is where things have started changing. After the divergence warned traders about the potential reversal, the price reversed its course and began a new uptrend. The negative divergence usually happens at the end of an uptrend. This type of divergence is usually useful when there's no resistance zone to use in an analysis. During long bull markets, many securities make new record highs and it becomes quite hard to predict reversals. This is when negative divergence helps a lot. Traders can spot this type of divergence when the price advance does not get reflected in the indicator strength. When the stochastic starts to drop during a price rally, this usually translates into a possible downside reversal. Take a look at the monthly chart of SPY. The crash of 2000 is one of the best examples where you can observe a negative divergence that resulted in a big crash. The price was rising for many months, but the stochastic began gradually dropping. This decrease intensified once the crash occurred and only started stabilizing during the early months of 2001. Obviously, it is impossible to predict when exactly the crash will occur based on the indicator reading, but at least it gives traders an early signal to prepare for the reversal. Now, one thing traders need to pay attention to when using stochastic is that this indicator is notorious for giving false signals. A lot of the time, the signals just don't produce any meaningful reversals. Therefore, as I said before, use its signals only inside good quality support and resistance areas. Basically, try to avoid using stochastic signals somewhere in the middle of a trend. Because trust me, you will experience extensive stop outs. Doing transactions at the extremes should be your priority anyway, with or without the use of indicators, because this is where professionals place orders. Here's an example of what I'm talking about. Take a look at the chart of SPY. We have solid support and resistance areas that qualify as upper and lower extremes. Let's assume a trader wants to initiate a long position inside the lower extreme, which is the support area. Notice how the stochastic indicator already shows the buy signals even before the price reached the support zone. It did it 3 times before the actual reversal to the upside happened. If the trader initiated the purchase each time the indicator signaled to buy, he would have stopped out 3 times before the actual reversal occurred. It happened only when the price reached the support and when the indicator signaled once more to buy. This is why the price analysis has to be done first, and only after that is the indicator analyzed. This way the false signals can be eliminated and unnecessary stop outs avoided. So guys, do me a favor and always check for support and resistance areas first before analyzing indicators. In the next video, I will be discussing with you another popular indicator called Bollinger Bands. I hope you guys liked this content of this video. If you did, then subscribe and drop me a like. I would really appreciate it. Having said that, guys, have a wonderful day and I will catch you in the next video. Peace.